But in early morning market trading to kind of start the day off and to get some key insight, I'm joined by Michelle Snyder, partner and director of trading research and education for Market Gauge. Michelle, the S&P has been down for the last 4 sessions with investors concerned over COVID-19's impact on economic growth, as well as the Fed kind of signaling an accelerated taper on Wednesday, kind of making that signaling that during its minutes. What are you watching?
Well, there's really 4 aspects of the market to keep an eye on now. Obviously, inflation, which is finally on the lips of everyone. It even made the cover of Barron's this week. Earnings season, which is coming up this week, starting with the financials. I think that's going to be key. Interest rates, obviously. Goldman Sachs came out this morning. They think that the Fed could actually rise 4 times, and we'll talk about that more in a minute. And then money flows, because we had a record amount of money flow. $1 trillion of new money came into ETFs over the course of the year, not to mention about $800 billion in corporate buybacks. So if you put that all together, I think what we're really going to see here is not a full-on collapse of the market, but more will establish some kind of a trading range, which is good news and bad news. And that's going to be because of the money flow, lots of people still investing in the market, but the sentiment of the market is changing. The growth stocks and the big cap stocks that have been in favor for a long, long time, loving that free money, falling out of favor, and more value, energy, financials, staples, utilities now coming into favor.
And one of the first things you just mentioned was earnings, so let's go there. JP Morgan, Citigroup, and other big banks reporting earnings, as you mentioned, later on this week. What are you expecting, and what's your outlook on the credit and lending sector for this quarter?
Well, right now I believe that we're already seeing the anticipation that the bank earnings should be great, right? Look what's happening with Wells Fargo and Morgan Stanley and JP Morgan. They're all really rocketing here, even this morning as the market opened, partly because they happen to like higher interest rates. But it could be sort of at some point just get overbought, so I certainly wouldn't be a chaser up here. However, it is really interesting because what it shows, and I listening to the idea that the savings rate is up really high, I think it could actually mean that people will be looking for dividends, people will be looking for fixed income, people are going to be looking for ways to guarantee some kind of return on their money if the stock market itself is uncertain.
You know, as I mentioned kind of on the top, the NASDAQ taking the biggest hit, really kind of being pulled back by the overall tech sector. I mean, it has gotten slammed, 5% down in the last 4 weeks, just about 4% last week. The software industry, kind of the hardest hit, down 7.3%. Semiconductors down by 4.7%. Few questions for you here when we're looking at the tech sector and even just the NASDAQ overall. Which areas do you think are going to have kind of the most growth potential, do the best here? And then do you think the pullback that we're seeing in the NASDAQ and in the tech sector overall really signals a move from growth to value?
Well, yes, to answer the second part of your question, simply yes, but I like to really look at what's happened with ARK this year or over the course of the last several months, because I think it could be a harbinger of the tech sector in general. First of all, people are so shocked, but really everything, as we know in life, is cyclical. And the fact that they've enjoyed tremendous runs, semiconductors and the big growth stocks and Apple and Google, Amazon, et cetera, the fact that the disruptive tech has been maybe, like I say, the harbinger that we can continue to go down before we find some kind of floor, this could certainly happen in the tech. And so I would be very careful now in terms of what I would be looking at. I mean, obviously you want to look at the giants to see where, again, a floor comes in. You want to look at Apple. Can Apple find a floor somewhere around 160? It's already trading in the 160s, considering a couple of weeks ago it was making new all-time highs. So, I like to look at Qualcomm. That's been a solid company. I like to look at NVIDIA, obviously a solid company. Chip shortages have been a factor, but we haven't really seen them come home to roost. And yes, this could be the year where trying to buy dips on things that are falling is not necessarily the good plan, and rather go to the areas now that are showing either consolidation or areas of breakout with some kind of retracement, like what we're seeing in some of these value stocks.
You know, every analyst or expert that I've spoken to in the last several weeks have talked about energy being a major opportunity. You kind of noted that just a few moments ago. Energy up now about 10% in the last 4 weeks. Do you think this momentum continues? How long do you see it playing out? And how do you best play kind of this energy play?
Well, for one thing, let's break it down. So then there's the energy itself, and if we're looking just at the ETF, say XLE, that is making a really historic run here. And I think that continue to a point. Of course, we never really know. Some of these oil companies, I think, can continue to do very well. We're very always interested in British Petroleum because they sort of have their foot in two places. They have it in traditional oil and gas, and then they also have a foot into clean energy. And then oil itself, which got over $80 a barrel. Obviously, we've got some geopolitical concerns, but in terms of what OPEC just did, they're not raising their production and demand could increase. So we could see oil going to $85, maybe $100 a barrel, as many analysts are predicting. That's certainly within the realm of possibility. I also like to think of the ramifications of that. When everybody runs into the same space, I step back and say, okay, what happens from there? Yeah. And for me, clean energy, which has been pounded, by the way, especially compared to traditional oil and gas, completely different than the narrative, let's say, of the administration. Oil gets expensive enough, I think then you might start to see some of that opportunity come back in some of those more traditional clean energy like solar, TAN, or some of the just First Solar, some of the, Solar Edge, Sunrun, some of those companies that right now are been beat up.
You actually just kind of tangentially there touched on my next question, which is that, again, financials has been a play that many analysts and many experts have said are kind of the way to go, energy being another one of those as well. But aside from financials and energy, what industries do you see being undervalued at this time, or even just the next opportunity? You mentioned clean air as one.
Yeah, I definitely like that. I also have been talking a lot about the medical devices. And when I talk about medical devices, I mean beyond COVID, people have not really booked procedures that they ordinarily would have had in normal times. And I think that could come back. So I'm looking at companies that deal with selling hospitals in particular and doctors medical equipment that could deal with some more, not just elective procedures, but procedures that people have actually put off. That could be an interesting opportunity. And, I was thinking over the weekend about the metals. I know that they're very controversial. Gold has just been beat up as an inflation hedge, people saying, nah. But I started thinking about silver. And I started thinking about 1980, the Dow was trading at 1,000 and silver was trading at $40 an ounce. Now the Dow is 35 to 36,000 and silver is at $22 an ounce. Just doing pure math, it seems like the metals have to be, particularly silver, incredibly undervalued.
All right, always some great insight. Really appreciate it. Michelle Schneider, partner and director of trading research and education for Market Gauge.